Over 80% of investors think tech stocks always drive the market. They are wrong. Right now, tech giant earnings are splitting down the middle. Microsoft spiked on massive cloud growth. Meta plummeted after free cash flow collapsed. Meanwhile, old-school industrial stocks and oil producers are quietly touching new highs. If you keep buying index funds blindly, you are taking hidden risks. Next week could trigger a massive rotation across global markets. The Federal Reserve and the Bank of England both held interest rates at 3.75%. Central banks are refusing to cut rates faster. Oil prices briefly touched $100 per barrel. That price jump reignited inflation worries across the globe. Wall Street is repricing everything for the coming week. You must position your capital before Monday morning arrives. We are seeing a clear shift from growth to cash flow stocks. Smart money is moving into 3 specific global asset classes. What most people don't know is that volatility offers massive opportunities. You just need to know where to deploy cash safely. Let us break down the US market dynamics first. The S&P 500 is sitting roughly 1.6% below record highs. Under the surface, major swings are destabilizing tech-heavy portfolios. Nvidia, AMD, and chip makers took heavy losses last week. Capital expenditure in artificial intelligence is under intense scrutiny. Investors demand real profit margins now, not just big promises. Palantir reports earnings on Monday with huge market expectations. Wall Street projects quarterly revenue of $1.81 billion. That is an 81% jump year over year. However, Palantir trades at 61 times price to sales. Even a tiny revenue miss could spark a 15% drop. Instead of chasing sky-high valuation tech, look at value rotation. Industrial giant Caterpillar reports results this coming week as well. Caterpillar benefits directly from global infrastructure and mining demand. Their order backlog remains near historic record levels. Consumer staple giants like Coca-Cola are jumping 5% on strong earnings. They pass higher costs directly to consumers without losing sales volume. Adding high-quality defensive equities balances your tech exposure. It protects your overall portfolio during tech pullbacks. The surprising part comes next, when we cross the Atlantic Ocean. European and UK equities are offering incredible relative value. The London Stock Exchange has lagged US indices for months. Now, the FTSE 100 is positioned for strong performance. The Bank of England kept interest rates flat at 3.75%. Inflation in the United Kingdom fell to 2.6%. However, energy costs threaten to push inflation back up this autumn. That environment favors energy producers and international UK banks. Shell and BP are generating massive cash returns right now. When crude oil stays above $85, cash flows soar. These firms pay high dividend yields while repurchasing billions in stock. Pharmaceutical giant AstraZeneca offers resilient defensive growth for UK investors. In continental Europe, the Stoxx 600 index is seeing steady inflows. European industrial leaders are trading at a discount compared to American rivals. Valuations in Europe sit around 14 times forward earnings. That compares to over 22 times forward earnings for the S&P 500. Buying European defensive ETFs provides immediate global diversification. Before you skip to the end, consider fixed income strategies. Bonds are giving equity returns with a fraction of equity risk. Many retail investors avoid fixed income because they think it is boring. That is a huge mistake in the current interest rate environment. The Federal Reserve rate is holding between 3.5 and 3.75%. Futures markets now price in possible rate hikes later this year. Higher short-term interest rates make short-duration treasuries extremely attractive. Look at short-term bond ETFs like the iShares 0 to 3-month Treasury ETF, ticker SGOV. SGOV pays a monthly distribution yield near 4%. It carries almost zero price fluctuation or duration risk. Holding cash in standard bank accounts loses value to persistent inflation. Parking cash in ultra-short treasuries guarantees stable, liquid monthly income. If you want capital protection while markets rotate, SGOV is ideal. If you are enjoying these simple wealth-building insights, hit the subscribe button right now. Subscribing ensures you never miss our daily market breakdowns and actionable picks. For investors wanting medium duration exposure, look at 1 to 10-year Treasuries. ETFs like SGOV allow you to lock in yield across the yield curve. If central banks hold rates higher for longer, these funds produce steady cash flow. You get income stability without taking corporate debt default risks. What most people don't know is how to build a balanced weekly allocation. Here is how you should structure your strategy starting next week. First, keep 40% of your capital in core global dividend equities. Target resilient companies like Coca-Cola, Caterpillar, and Shell. Second, allocate 30% to ultra-short treasuries like SGOV. This gives you a guaranteed return while preserving liquidity for dips. Third, keep 20% in selective mega-cap tech with real profitability. Microsoft and cloud leaders have proven earnings power and strong enterprise demand. Finally, hold 10% in cash equivalents to exploit earnings volatility. Major earnings announcements from Palantir and AMD will create wild intraday swings. Never chase a stock after a 20% single-day rally. Wait for post-earnings pullbacks to enter high-quality business models. Risk management is far more important than picking winning stocks. Set strict stop losses on speculative positions to preserve trading capital. The upcoming U.S. non-farm payrolls report on Friday will move markets. Economists expect 83,000 jobs added and 4.3% unemployment. A hotter job market means central banks will keep interest rates elevated. A weaker job market could spark economic growth concerns across cyclical sectors. By balancing equities with short treasuries, your portfolio thrives in either scenario. You earn yield while keeping upside potential across global equity markets. Look out for our next video posted daily to stay ahead of Wall Street.